Understanding financial statement in 5 minutes. There are 4 major financial statements in accounting. First, statement of comprehensive income. Second, statement of financial position. Third, statement of cash flows. Lastly, statement of changes in equity. Let's go through the first statement. Statement of comprehensive income. Starting with the title. Then, we will begin the statement with revenue minus cost of sales and arrive to gross profit. After that, deduct other indirect expenses like distribution expenses, administrative expenses, and impairment loss. We will then get the operating profit. Then, deduct finance costs and add investment income and arrive to profit before tax. After deduct income tax expenses, we will get the profit or loss for the financial year. We will then include other comprehensive income item to arrive the total comprehensive income. Why do we need statement of comprehensive income? First, we are able to do profitability analysis by reviewing the revenue, expenses, and net income. Secondly, we can do performance evaluation against past performance, competitors, and industry benchmarks. Thirdly, we can do budgeting and forecasting based on the statement of comprehensive income. Next, this statement is one of the requirements for reporting standards. Lastly, we can do tax planning based on the income and expenses amount. Second statement, statement of financial position. Starting with the title, we will begin with the left side. The assets item. First, we will have our non-current asset, such as property, plant and equipment, and intangible assets. Second, we will have current assets, like inventories, trade payables, prepayments, other current assets, and cash equivalents. For the right side, we have equity, such as share capital, share premium, revaluation reserve, and retained earnings. Next, non-current liabilities, long-term borrowings and provisions. Lastly, current liabilities, such as trade payables, short-term borrowings, current tax payable, short-term provisions, and accruals. What can we use statement of financial position for? First, as a snapshot of our assets, liabilities, and equity as at the period end. Second, for liquidity analysis, by comparing current assets and current liabilities. Thirdly, for strategic planning use, such as capital structure, financing, and resource allocation. Lastly, statement of financial position is also one of the requirements for reporting standards. Third statement is statement of cash flows. Basic cash flow is start with the title. Then cash flow from 3 different activities, such as operating, investing, and financing activities. The net increase or decrease in cash should be equal to the differences between cash opening balance and closing balance. Statement of cash flows direct method. Start with the title. Then beginning the cash flow from operating activities section. Add cash receipt from customers. Then deduct cash paid to suppliers, employees, interest, and taxes. Second, cash flow from investing activities section. Add cash receipt from sale of long-term assets and dividend received from investment. Then, deduct the purchase of long-term assets amount. Third section, cash flow from financing activities. Add proceeds from an equity share issue. Deduct long-term debts payment and divided paid to investor. Finally, we total up the cash flows from 3 sections. Then, we will arrive to net increase or decrease in cash during the period. For indirect method statement of cash flows, the difference will be only the cash flows from operating activities part. We will start with profit or loss before tax. Add back non-cash expenses such as depreciation, amortization, and impairment loss, and gain or loss on sale of non-current assets. Next, take into consideration on adjustment for movement in working capital such as inventory, receivables and prepayments and payables and accruals. Lastly, deduct interest and tax paid to arrive net cash flow from operating activities. The reason of having statement of cash flows. Firstly, to monitor whether our operating activities generate positive cash flows. Second, with more cash flow, we can make investment decision to purchase long-term assets. Third, liquidity analysis to ensure sufficient cash to pay bills. Fourth, having enough cash to pay cash dividend to investor. Finally, it is also required by reporting standards. Our final statement of changes in equity. Starting with the title, then, we will create a table with share capital, share premium, revaluation, retained earnings, and total equity column. Then, we will start with the balance from previous period for the row. Then, include all the events that will affect the equity, such as issue of share capital, dividends, revaluation, and total comprehensive income. Then, we will arrive to the closing balance of the period. The statement of changes in equity is primarily for the use of investor. Investor can understand how the equity position evolved, such as net profit or loss, share purchase, dividend payment, sale of stock, any related activities. Management may also make decision on equity based on the statement. Lastly, it is also one of the requirements under reporting standards. There are different names under different reporting standards. However, the meaning is still the same. Thanks for watching this video. If you find this video interesting, remember to like, subscribe, and share. We will create more informative video in future.